concept of taxation, it's one of the fundamental aspects of the economy. Taxes themselves are used to finance public services, public goods, and other important things for society. And the U.S. tax system follows basic tax system principles. We have the two most common principles, which is the ability to pay principle and the benefits principle. The benefits principle specifies that anyone that benefits from any social service, any social public service, like a public park, highways, and public education, public libraries, public infrastructure, should pay the appropriate taxes. Meaning, if all of us benefit from some form of tax goods or public goods, as they are referred, we should pay our share of taxation. The other U.S. tax system principle is based on the ability to pay principle, which means that if we're able to earn income and our income progresses and it increases over time, we should pay a higher tax rate as our income progresses. So the U.S. system is highly progressive in terms of the ability to pay principal, and we have a lot of benefits when it comes to public amenities, public parks, public services as well. When we're looking at the U.S. tax system, there's two structures that are responsible for controlling the tax into our country: the California State Franchise Board, or just the State Franchise Board for every state, and the Internal Revenue Service for the federal structure of the U.S. tax laws. Those two combined help collect the taxes that are collected by the public or paid by the public. And often cases, people argue that we should have a lump sum tax, the same for everyone regardless of income. In this one, it's $5,000 for Jonathan, $5,000 for Rosette, $5,000 for Giorgio, Jasmine, or Mika. Everybody pays $5,000 regardless of income. The high income earners pay $5,000. Low income earners may pay $5,000. It's efficient. Everybody collects the same amount, and we know the revenue. But it may be unfair to low income earners that may not be able to pay the full lump sum. So it's often not included in the tax law. The U.S. has what is called a progressive tax structure. It takes a higher share of income, a higher share of taxes to high income earners than it does to lower income earners. This is highly at the federal level. At the federal level, your marginal rate of taxation increases. And at the state level, we have what is called a regressive tax structure. A regressive tax structure means that high-income taxpayers will pay a relatively smaller share of their income in comparison to low-income taxpayers. Regressive tax system, typically at the local or state level. Progressive tax structure is primarily at the federal level. And how individuals are taxed is on the marginal rates of taxations. We have specific percentages that specify the percentage of income that is taxed away. And these percentages are in categories: 10% to lower income taxpayers, 15% to 20% to as your income increases, 20% to 25% with your middle income abilities, 30%, and it caps and tops at 39% right now. One of the highest marginal rates of taxations that we have, it's about 38 to 39% of the income. That's for high income earners. Most of you, the majority of you as professional individuals in your professional fields with relatively good income and high income abilities will be probably somewhere between 25 to 30% or 35% marginal rates, if not even in the higher marginal rate of taxation if your income increases significantly as progressive mechanisms. Now, when we're looking at further understanding the tax system, the general view is that the progressive tax system is a lot more fair than the regressive tax structure. Although we do have regressive tax structures at the state level, where some states offer tax incentives or tax laws that are friendly. Think about Nevada, for example. Nevada, you go and gamble there, you pay relatively low taxes, depending on the state. So states have the ability to set different state laws that are regressive at the federal level, highly progressive. The following are progressive and regressive. Personal income tax, highly progressive. Payroll taxes, somewhat regressive because they are small percentages. 1 to 2% for Social Security, 1 to 2% for Medi-Cal. It actually specifies on your paycheck. Medicaid, Medi-Cal, unemployment insurance are all in your payroll taxes. We have sales tax, which are goods and services that all of us buy, whether it's a service or a good. It's generally regressive. Can someone look online? What's the California sales tax right now? Because it says percentage of sales, and that will be the same for everybody, regardless of income. And we have taxes that are collected by government from all sources: city government, state government, federal government, and etc. So it's 7.25%. Thank you, Mika and Luke. It's lower. In recent times, the taxes have dropped significantly. 2 to 3 percentage points, they have declined. So if anything, marginal rates of taxation are declining. That's how the public are taxed, which is good. Now, several taxes exist. We have income tax, which is everybody. Payroll taxes depend on the earnings an employer pays to the employee, and the employer sends those taxes to the government. We have property tax. If you own property, family, mom or dad, or a relative owns a property, it's based on the value of the property, about 2% on the value of the property. Then the property values vary. We also have the wealth tax. If you inherit wealth and it's transferred to you, you have to pay taxes when you inherited that wealth. And it has different percentages. Sales tax is the most common paid tax by everyone. It depends on the number of goods that are sold. And everybody, for the most part, the majority of consumers may pay a sales tax, which is referred to as an excise tax in the technical manner. And in California, those of you that mentioned is 7.25% is paid by all of the consumers. So when someone says there's groups that don't pay taxes, there's different categories of taxes that are paid in different proportions. Income tax, if we have low income earners, they have low marginal rates of taxation. Like someone that's making $15,000 a year may be in the lowest marginal rate, and they may receive a tax credit, tax refund, or tax return, or supplemental government income. So when we're looking at income, it really depends on which quintile of the population the person is falling. Middle class income earners pay a higher percentage than lower income earners. They sometimes even get supplemental assistance. But sales tax is paid by everyone in this case. So we're going to look at sales tax, because sales tax, we can actually see the economic model, how it changes the price, and how it creates government revenue. All of them do. But this one is paid by the general consumer base, regardless of demographics. So the sales tax, or commonly technically referred to as an excise tax, it's a tax on all goods and services that are sold in the market. And what it does, it increases the price paid by the buyer. We as the buyer, we're going to pay a higher price when we have an excise tax. And it reduces the price received by the seller of the good. And in California, we saw that it's $7.25 or so. And it creates a gap between prices. So I have here an actual receipt that I went to purchase an item. So I have the price paid by the consumer, which is me, $418. The unit price was $380. That's how much it was. So as a consumer, I pay a higher price because of the tax, $418. The seller gets to keep a smaller amount. So there's a gap between prices. We have the consumer price and we have the seller's price. So what we have is this wedge between prices. We have a wedge between the price level. The consumer pays a higher price, the producer keeps a lower price, and the difference is the actual tax levy in the market for the good or service. And then we have examples of goods like gasoline, cigarettes, hotel rooms. Think about when you go out to eat with friends, you get the tax, the check, the bill, and you get the amount plus the tax. Or when you go buy clothing, shoes, or a service, the tax is added on. So here we have the demand for hotel room services, the demand by consumers, which is all the consumers in the market, the supply of the good by the sellers, and at $40, there's no units offered. At $60, we have 5,000 units offered. At $80, in equilibrium, we have the equilibrium price and the equilibrium quantity. We have $80 are in equilibrium and 10,000 units offered in equilibrium. The tax can be placed on the consumer or on the producer. Depending on who the tax is levied or placed on, the supply or the demand curve will shift according to the tax. Right now we have a free market with no tax. There's no tax in the market, and we have an equilibrium market price of 80 and an equilibrium market quantity of 10,000 units without taxation. If we place the tax on the producers, the supply curve will be affected. An increase of a tax to the producers is going to create a shift in the supply curve. It's going to shift the supply curve by the magnitude of the tax. So let's take a look at the case when the suppliers are the ones receiving a tax by government officials. If you notice here, the supply curve is S1, the demand curve is the normal. If you increase the tax to the producers, the supply curve will shift. The supply of goods will shift. The supply curve on the producers means that the supply curve here, when you tax the producers, the production of goods may decline. So the equilibrium quantity was 10,000. With the tax on the producers are going to adjust the supply of goods to supply curve 2. At a new equilibrium point A, they're going to raise the price to 100. The equilibrium price is now 100, and the equilibrium quantity drops to 5,000. This is often referred to as, if you tax the producers can cut supply of goods. They can decrease the supply of goods because now you're putting a burden to the producer by charging them a tax. And it's going to change the equilibrium price from $80 to 100. The question here is that we as consumers, we pay $100, and the tax in the market has shifted the supply of goods by the amount of the tax. What's the tax? We have a $40 excise tax that is placed or levied on the suppliers. The consumer price is 100, point A, in the new equilibrium price, 100. But what is the price received by the seller net of taxes? We as consumers, we pay 100 when the tax is placed on the seller, and we have a $40 tax. What is the net price the producer actually keeps once they have accounted for the tax in this case? The consumer pays 100. This is the consumer price. As consumers, we pay 100. And the seller is responsible for paying a $40 tax to the government, so they only get to keep 60. Let's see what someone said. 60. Santiago mentioned 60. And we can see it in the model. If you look at the old supply curve, where they get to keep 60, and you have two different prices. The consumer pays 100. The producer gets to keep 60. What if we place the tax on the consumer? What if the tax is instead on the consumer rather than on the actual producer? Well, if you tax the consumer responds by decreasing the demand for the product. If you tax consumers are going to respond by demanding less, because now they have to be the ones responsible for paying the tax in the market. The consumer demand decreases. It's going to be a decrease in demand by the consumer, and the shift in demand is by the magnitude of the tax. We have a $40 tax in the market. Demand drops by the magnitude of the tax. In equilibrium, we're paying 80. Now the consumer with the tax is going to pay $60 to the seller. So this demand curve intersects the supply curve at point B. The demanders, which are us as consumers, we pay $60. We have the new equilibrium price, 60. For 5,000 units, we consume less. And we pay the seller $60. Now we need to also send the government $40 in taxes. So that we have two bills. We pay the seller in the market 60, but now we have to also send the government $40 in taxes for buying the product. So we still pay 100. We still have to pay 100. The seller keeps 60 because that's net of taxes plus the tax, we pay 100. Regardless of who the tax is levied on or placed on, the effect is the same. The consumer pays a higher price and the seller receives a lower price. The difference is the actual tax. So let's take a look at the benefits and the model of taxation and how it behaves. The benefits of taxation, of course, is the potential revenue that is raised to the government and that the government collects from all of the sources of taxation. And this revenue is used to pay for public services, to cover public officials' salaries, public offices, public services, public infrastructure, public goods, necessities or amenities that are needed for the public or society at large, the infrastructure, and so on. And how much revenue is collected by government due to the tax in the market is the following revenue. Government tax revenue, it's equal to the actual tax in the market in numerical value or in percentages times the amount of value collected. So we have the actual tax in this case times the quantity transacted post-tax. And this revenue is going to be illustrated in the graphical illustration of the excise tax. Government tax revenue is the actual tax times the quantity transacted after the tax is imposed, because we have the equilibrium quantity with no tax, and then we have the quantity transacted after the tax. And you'll be surprised, we have government revenue that does help facilitate a lot of public services that are essential for society. But sometimes government officials can deviate the funds and keep some of this tax revenue for themselves. It has happened in different parts of the world. It happens in different cities for city budgets and so on. You may look at the city of Bell Gardens, city of Bell. The local mayor there deviated funds and paid himself $1 million. It's a true story. Look at it online if you have time today. And you can send us the what happened to that government official. He paid himself $1 million to fund public services. But anyways, we have government revenue that can be used for society's benefit at large. So here we have the market equilibrium price at $80 with no tax. Quantity transacted 10,000 units. And if we set a tax in the market to the general market at large, we see the consumer will pay a higher price and the producer will receive a lower price. So on the demand side, on the consumer demand side, the consumer pays 100, point A, consumer demand. The producer is going to keep only 60 on the seller-producer side, and the vertical distance between point A and B is the actual tax. And anything in between is the tax revenue. So how much is the tax revenue collected from this simple $40 tax? That creates two different prices. The consumer price, 100, the seller's price, 60, and the units transacted are 5,000. We have, in this case, what's the revenue? There's a question as to where does point B come. This is when we're taxing the market, Julian, for both the consumer and the seller. The outcome is the same. Hold on, let's see. The point A indicates the consumer price, the higher price to the consumer. The consumer is paying $100. This is our consumer price. If we have a tax of 40, how much is the seller actually keeping? If the consumer pays 100 and we have a tax of 40, what is the net price received by the seller? So it's I think it's 60. So that's $60. $60 is going to be received by the seller here. The seller is going to receive 60. The consumer is going to pay 40, and they're going to supply 5,000 units. So that's where this point B is coming from. The gap here is 40, and the tax here between these two prices is 40. The area in between, we have a tax of 40. We sell 5,000 units. We collect government tax revenue. And if you notice, the other areas are also there. These areas are of importance, and we are going to find what those areas are. But for now, we're collecting revenue. We're seeing what the consumer price will be, what the seller's price will be after the tax. This is referred to as the incidence of taxation. The incidence of taxation means who bears the burden of the tax in the form of a higher price to the consumer or in the form of a lower price to the seller. The burden of taxation, essentially what it means is the consumer going to pay more given the price of the tax or less? And if so, are they going to split the tax? And how are they going to split the tax? Sometimes the consumer may pay more due to the tax, or sometimes the seller may not pay a lot in the form of a tax. Who really bears the burden of taxation really depends on the elasticities of supply and the elasticities of demand. The incidence sometimes is placed more on the consumer in the form of a higher price, or sometimes it's actually placed on the seller, where the seller is the one responsible for paying the majority of the tax. So the incidence, in this case, the incidence of taxation is just a technical way of specifying who is going to be the party responsible for paying the majority of the tax. And typically the consumer is the one that may be the one paying the majority of the tax in the form of a higher price. So next time you go out to eat, for example, just take a look at your regular bill, $100 if you go out to eat with friends, and the tax, which is like, at 7.25% service tax. Or it could be more, it could be less, depending on where you are. And you paid the final price. But out of those 7.25%, it's possible that we as consumers were paying the majority of that. And the seller is only paying a small percentage. Okay, great. So what determines the burden of taxation? What determines really how the incidence or the burden of taxation is between consumers and producers is the elasticity of supply and the elasticity of demand. The elasticities of supply are the responsive behavior of producers. Are producers highly responsive? If you tax the producers, they're going to respond. And we saw that they're either going to respond by supplying less. If you tax them, they're going to supply less, or they're going to change their production to something else. The consumers, if you tax them, their elasticity behavior is going to also be responsive. We can have elastic consumers that respond a lot, or we can have inelastic consumers that don't respond a lot. Again, here, elasticity, we're not going to calculate elasticity because we did that in Chapter 6. We're going to look at the responsive behavior. Elasticity is responsive behavior of producers. Elasticity of demand is consumer response behavior when you tax them. And this can create a tax burden that fall unevenly, meaning that consumer may pay all of the tax, the majority of the tax, or most of the tax, or the producers are the ones that are responsible for paying the majority of the tax. We're going to look at two scenarios when it comes to taxations, when the consumers are the ones that are paying the majority of the tax, and the other scenario where the producers are the ones paying the majority of the tax. And to do that, we're going to have to do it with elasticity. So in the first case, when the price elasticity of supply is higher or more responsive than the elasticity of demand, the tax falls heavily on the consumer. This is a technical explanation of elasticity, but we're going to do a model. Model 1 is going to illustrate this explanation. When the price elasticity of supply, when producers are highly responsive and you tax the market, the tax falls on the consumer. Another way of specifying that, because I know elasticity is a little confusing. When the price elasticity of supply, meaning that the producers are highly responsive, then the consumers, the tax will fall mainly on the consumer. So we have a tax model that will indicate and show that when you tax the market and they have different elasticities, the consumer will be the one responsible for paying the majority of the tax. The second model, and the second point, indicates that when the price elasticity of demand, meaning that the consumers are the ones that are highly responsive, is higher than the price elasticity of supply, and the producers have no option but to take the tax falls mainly on the producers. So sometimes either the consumer pays the majority of the tax, or sometimes the producer pays the majority of the tax. It has to do with the elasticity of demand and the elasticity of supply. That determines the incidence of taxation. In true factor, in most of the market, the consumers pay the majority of the tax. Not all of it, but most of it. The producers transfer any additional costs to the consumers in general, because most of the time the producers are highly responsive to taxes when they are taxed. No one really likes to be taxed, and taxes are not that friendly. And historically, marginal rates of taxation have declined. Marginal rates of taxation for the producers, for consumers, for the American household, for most people have declined, which is important to consider. Let's take a look at the first point, when the elasticity of supply is more responsive. This is the first model for the consumer paying the majority of the tax. We have consumer demand, and we have the supply of the good. The demand curve here is a little bit steeper, more inelastic, low consumer response. Price elasticity of demand could be relatively low, highly inelastic. The price elasticity of supply here, if you notice, is relatively horizontal, relatively flat, highly elastic. And if we tax a product like gasoline, in equilibrium, the equilibrium price is $3 for the product. In California, there is excessive taxes on gasoline. Californians do pay a little bit more in taxes due to the environmental regulations and what's included in there. California does have high taxes for gasoline consumption. So there's a question from Jonathan. Change in consumer surplus, change in producer surplus. Yes, the tax changes the consumer surplus and the producer surplus. So here, the change in consumer surplus is greater than the change in producer surplus. Yeah, because you're taking a lot more to the consumer. If I'm understanding that correctly, you're charging the consumer more. So here we have a $1 tax in the market, and remember and keep in mind to not just add the tax from the equilibrium point. It is split. Again, it's split. It happens here that the consumer takes the greater burden of the tax by paying the majority of the tax here. We have a $1 tax, and the consumer, instead of paying some of it, it pays the majority. From equilibrium, they are going to now pay $3.95. The majority of the tax is paid by us, the consumer. And since we're paying the majority of it, our consumer surplus is going to change more. Or where the consumer surplus effect has a greater effect. And the producer, they were getting $3 in equilibrium. Now they're only getting $2.95, so it's $5 cents less. So they still get close to the same amount in equilibrium. Most products that are inelastic in consumption, when you tax them, the consumer pays the majority of the tax, and the producer receives close to the same amount in equilibrium. If we look at the secondary case, when the producer is the one responsible for paying the majority of the tax, the model will be a little bit different. So here, inelastic goods in demand, when the demand is low or inelastic, and the supply curve is highly elastic, the consumer pays the majority of the tax. The secondary model shows when the producers are responsible for paying the majority of the tax. We have the supply of the good, which is relatively low or somewhat inelastic, and we have the demand of the good, which is the consumers, which are highly elastic when you have significant response. The equilibrium price is $14, and the tax in the market here is going to be a $4 excise tax. That's going to be split between the consumer on the consumer demand, point A. The consumer pays $15, and the producer receives the major burden of the tax by receiving significantly less, $11. So the burden falls mainly on the producer in this tax model when the price elasticity of demand is significantly higher or very elastic than the elasticity of supply when it's inelastic. The burden is on the actual producer. Now, can someone think of a product that it's where the producer is the one primarily paying the actual tax? There may be certain producers that pay the majority of the tax to produce a good. But for the most part, we're looking at Model 1, where the consumer pays the majority of the tax in the form of a higher price. This we have here the situation of parking spaces. But in the actual market, does any company come to mind where the producer is the one responsible for paying the majority of the tax, and the consumer pays a little bit more, but not significantly more than equilibrium? Very few companies come to mind, actually. I would think that most consumers are the ones paying the majority of the tax, because businesses typically pass on the cost to the consumer to some extent. But again, it's split. The percentage split is different. Any questions, comments, thoughts? Okay. Now, when we're looking at the further analysis, maybe cigarettes. Okay, that's a good point. This one is actually on the industry tax. The government officials tax the companies, but the companies pass it on to the consumer, because the consumer is the one that is really want that cigarette. So yes, that one, the tax is intended to be on the producer, but the producer responds by passing the tax on to the producer in the form of a higher price. Great question. Thank you. Good point. Good observation. Continue on with tax benefits and taxability. Taxes change the market. We collect revenue. It also affects the price the consumer pays and the price the producer receives. And it changes both the consumer surplus and producer surplus. Consumer surplus may be lower if the price is higher, and the producer surplus may decline if the producer receives a lower price. And part of that consumer and producer surplus becomes government revenue. And what it used to be, consumer surplus may essentially become what is called inefficiency loss. So let's take a look at what happens to the general tax model and the areas and how they are adjusted. With any tax in the market, we have an excise tax of magnitude T. We're going to have a higher price to the consumer, that's point A, on the consumer demand, and a lower price to the producer on the supply curve. The distance between the consumer demand price and the producer price is the actual tax. In equilibrium, there's no tax, and we have quantity transacted in equilibrium. With the tax, we have two prices. We have government revenue, that is the area in between, right in the center, which is a rectangle, and the other areas become smaller. This area here, if you recall, consumer surplus is the area above the price and below the demand curve. This is the new consumer surplus. Producer surplus is the area below the price and above the supply curve. This becomes producer surplus, which is a lot smaller. Part of that becomes government revenue. And the heart of the model, the center part of the model, becomes deadweight loss. The objective of taxation is to maximize government revenue, minimize the deadweight loss, and in this case, minimize any inefficiencies associated with the tax. The deadweight loss occurs because we have quantities that is lower below the equilibrium. If the consumer buys less units at a higher price, there are some units that are lost. If the producer decreases production below the equilibrium, there's less quantity transacted after the tax, and that becomes some form of lost market activity. And the value of that deadweight loss can be estimated. Someone recall that we need to estimate the value of deadweight loss by the area of the center part of the model. 1/2 the base times height will give us the deadweight loss. So we have various things that are affecting the market due to a tax. So the essential cost of taxation is the deadweight loss, some inefficiency, some mutual beneficial transactions don't take place anymore, and some transactions are, in this case, foregone and no longer taking place. That generates a loss to society, plus any additional administrative costs to file taxes, the administrative buildings for the State Franchise Board or the Internal Revenue Service Board. We need to spend some time filing for taxes, collecting the tax, and allocating the tax accordingly. All of those are costs of taxation. And we want to minimize the cost of taxation and optimize market activity. Consumption needs to continue. government revenue needs to be the highest possible, and minimize any other form of inefficiencies. So a combination of deadweight loss and administrative costs need to be minimized and optimize revenue and still have consumer transactions. Very important. You want to minimize the administrative burden to the public, to society, and minimize any potential losses that can occur in the market. Okay, and elaborating and deconstructing the model a little bit more. In equilibrium, we have the equilibrium price and equilibrium quantity. And the area of consumer surplus is above the equilibrium price and below the demand curve. And the area of producer surplus is the area below the price and above the supply curve. Once you set the tax in the market, it's going to increase the price to the consumer and decrease the price to the producer. Part of this area become government revenue, but we see here that area A and area B is a decline in consumer surplus, and area C and F is a decline in the producer surplus because the producer surplus is now a lot lower. The area of producer surplus is a lot lower, and the area of consumer surplus is a lot lower. Area A and C show a decline in both consumer and producer surplus that is now transferred to government revenue. Area B and F become deadweight loss. Become deadweight loss in the market, and the quantities transacted has declined from equilibrium. So again, we want to minimize deadweight loss, optimize government revenue, and still have consumer and producer transactions taking place. Any questions, comments, thoughts, or observations? Thank you, everybody, for